Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Erik Oliver. Erik is the Vice President of National Accounts at Cost Segregation Authority, a national provider of cost segregation services. These services assist building owners who have constructed, bought, expanded, sold, or remodeled depreciable real estate in maximizing tax benefits. Erik, I'm looking forward to diving into cost segregation, kind of get your thoughts on a lot of things that are happening right now. Obviously, we're in a kind of a unique time with a new president coming into office here, I guess, on Monday. Hopefully, there'll be some things that happen there, but we'll see with respect to the your cost segregation field. But I like to typically start with really kind of your background, where you grew up and what eventually led you to being in this cost segregation field.
Yeah, great question. Thanks for having me again, Keith. So I grew up in Salt Lake City, Utah, so born and raised in Salt Lake. Went to school here at the University of Utah, got my degree in accounting. Like most 18-year-old, 20-year-old kids, I was in school trying to figure out how I could get out of school as quickly as possible. Math always came a little bit easier than some of the sciences or English. So I'm like, okay, it's either going to be a finance or an accounting degree. Ended up with an accounting degree because I think it was a few less classes I had to take, and I was able to get done a little bit sooner. So anyways, got an accounting degree. I never really used my accounting degree. I kind of got into business development. That took me to the East Coast, where I worked for a number of years, about 12 years in Richmond, Virginia, doing kind of sales. And then my father-in-law had a landscape business up in Long Island, New York. They've had for 30 years. My wife was doing the books for him, and he was ready to retire. And so he's like, hey, why don't you move up to New York? I'll teach you the business. You guys can buy the business. So we left Virginia, went to New York for about 5 years. After 5 years, my father-in-law still had not retired. I think my wife and I made it a little too easy for him when we were up there. And so he's like, hey, I can keep doing this for another 10 years as long as you guys are doing all the work. So anyways, was looking to leave New York. I had some aging parents. Like I said, I was born and raised in Salt Lake. So I was looking for jobs in Salt Lake City, or at least the area. Came across this position at Cost Segregation Authority needed some business experience or business development experience, and then obviously some accounting experience. And so it was kind of a natural fit. Honestly, Keith, I didn't know what cost segregation was. I had to watch the YouTube videos before I went and applied for the job, so I sounded like I knew what I was talking about. But once I got into it, I've been doing it for about 8 years now. It's been great. Love working with investors and tax preparers across the country, helping reduce tax liability through some of the services we offer. And it's also kind of given me an opportunity to get into real estate myself. I've got a few properties. I kind of fell into real estate. I think they call it an accidental landlord. I sold my house, when I went from Virginia to New York, I kept my house in Virginia, and learned a lot of lessons there on my first rental property, trying to manage it myself from, 4 or 5 states away. It was not a good experience, but This job is I get to go to conferences, I get to speak at conferences, I get to learn from people all the time. And so I've really been able to learn a lot about real estate in the last 8 years and been able to invest in some fun projects.
Great. And so for the audience, if you could kind of explain what is a cost segregation study and what does it do and how can one benefit from having that done to their properties?
Yeah, great question. So cost segregation, Keith, really is just accelerated depreciation on your real estate assets. So when we buy a piece of real estate, as long as it's a revenue generating property, the IRS allows us to depreciate that over either 27 and a half years if they're residential units or 39 years for commercial buildings. So just to make the math easy, if you buy an office, let's say you buy an office building for $390,000, you take that $390,000, you divide it by 39 years, and essentially you're getting a $10,000 write-off every year for the next 39 years. Now, I've oversimplified that a little bit. You always have to subtract out the land value. So you take your purchase price minus the land value. That gives you in that example, the $390,000. We take that, we divide it by 39 years, we get a $10,000 write-off every year. So this write-off is it's a non-cash expense, just like any other expense. It comes off of our taxable income. So let's say I make $110,000 a year in income. Instead of paying tax on 110, I've got this $10,000 deduction. I get to reduce my taxable income by that amount, and now I'm only paying tax on 100,000 in that example. And so that's called straight line depreciation. That's what a lot of people do, is they just take that standard deduction. Well, with cost segregation, we want to accelerate those deductions and get them at a much faster rate. I don't want to wait 39 years to realize all my deductions. I may not even own my property at 39 years.
Yeah.
So how can I get more of those deductions now? How can I front load that depreciation? And the way we do that is through an engineering-based study where we go out and we identify the different parts of your building and put values to those different parts. So again, if I buy an office building for $390,000, a cost segregation study will come in and say, okay, well, the parking lot's worth $62,000. The flooring in your building is worth $12,000. The appliances in the break room are worth $8,000. And we go through and we segregate, just as the name implies, all the different pieces of your building. We put value to those. And now, according to the IRS, carpet, for example, has a 5-year depreciable life. So whatever the value is of my carpet in my building, I can now depreciate that over 5 years instead of spreading that amount out over 39 years. So actually, Keith, if you don't do cost seg, if technically you're breaking the law by depreciating your assets at the wrong useful life. So for example, if I don't do cost segregation and I depreciate my carpet in this office building over 39 years, that's technically incorrect. Now, is the IRS going to come after you and say, hey, you're not taking enough depreciation, you're not taking enough write-off? No, they're not going to come after you because it's just more money in their coffers. But technically, according to the tax code, you're doing it incorrectly if you're not depreciating, for example, your carpet over 5 years. So that's kind of cost segregation. And the idea, again, is just to front load or take as much depreciation in the early years so you can create cash flow, greater cash flow in those early years. You can, take that cash flow, go pay down your debt. You can go reinvest it in new buildings, do what you want with that cash flow. But the idea is to take your deductions now versus letting the IRS hold on to these over the next, 27 and a half or 39 years.
Yeah, and it makes sense because the carpet example was a good one because your carpet is going to wear out well before 39 years,
Right.
and so why you wouldn't prepare for that? Same thing. What is like say a driveway or a parking lot? What can you reduce that down to?
Yeah, so that's a good question. So all of your exterior, what we call land improvements in the industry, so everything outside the building that is not dirt. So we're talking about your curbs, asphalt, concrete, retention ponds, drainage, signage, exterior lighting, parking spaces, all that stuff, all that cost to that outside stuff are land improvements. They get depreciated over 15 years. And then all of your interior stuff, blinds, flooring, cabinets, countertops, ceiling fans, garbage disposals, all of that stuff, those are your what we call personal property, which is 5 or 7 year assets. So we're taking an asset where we're depreciating the whole thing, the one lump sum over 27 and a half or 39 years. We're breaking that up into either 5, 7, or 15-year assets, with the remaining amount being 39 years. Because there is still some structural stuff in here that's 39 year. The windows, the doors, the sheetrock, those are all 39-year assets. So to give you some perspective, we usually segregate around 30% of a building into short asset life. So again, I like to make the math easy. If we buy $1 million building, we're going to find roughly $300,000 worth of stuff, parking lots, curbs, gutters, ceiling fans, cabinets, all that stuff, about 300,000 on the typical building. Now that's an average in our industry. An industrial building that maybe is just cement floor with 4 walls, we might find less. Multifamily, where you've got a lot of stuff in it, we might find more. But on average, it's around 30%, with the exception of about 3 different asset classes. And I'll go over those just quickly because I think it's important for the listeners to know. But I don't know about you, Keith, in San Antonio where you're at, but here in Salt Lake, car washes are going up on every corner.
Yeah.
And part of the reason the car washes are going up on every corner is they're a huge tax write-off. So when you build or buy a car wash, what are you buying? You're really not buying a building. You're buying land improvements, curbs, gutters, asphalt, concrete, and then you're buying a bunch of equipment.
Yeah.
Well, all that stuff can be depreciated over a very short, useful life. And so they're great asset classes. So if you spend $1 million on a car wash, it's not uncommon for us to find $900,000 worth of stuff that can be depreciated at a much faster rate. So car washes are unique. Mobile home parks, another unique class. Again, you think about when you buy a mobile home park, sometimes you're just buying roads and cement pads and trailer services. Sometimes there might be a little structure. Maybe it's got a laundry facility or a clubhouse or something along those lines. But oftentimes you can get a very high segregation amount on mobile home parks. And then the last category is car wash. I mentioned car wash, gas stations. So when you're buying a gas station, oftentimes that whole gas station, instead of being a 39-year commercial property, it gets treated as a 15-year property, and you can depreciate all of it over 15 years. And then there's something called bonus that allows you to take it even faster than that. But those are kind of the 3 outliers.
Okay. Yeah, no, that makes a lot of sense. And we specialize in mobile home parks, at least with my company. So that's great. One of the thing I didn't recognize or realize really until I guess probably about a year ago, and I'll let you speak to this, but I didn't realize that. I just assumed if you didn't take you didn't do a cost segregation study when you purchased it, you kind of left that on the table and that was it. But my understanding is now you can go back to actually the year you purchased it, and we can certainly talk about bonus depreciation here in a minute. But my understanding, and again, correct me if I'm wrong on this, but that you can actually take the bonus depreciation as well if you purchased it, in the year that, say, was 100% bonus depreciation.
Yeah, no, that's correct. So the IRS allows us to do what they call a look-back study. And so let's say you bought a property in 2018. You never did a cost segregation study. So you've just been taking your standard, 1/39th of a deduction for the last, 6 years or so, 7 years.
Uh-huh.
And then here in 25, you've got all of a sudden you go meet with your tax preparer, your tax strategist, and they're like, hey, you owe a lot of money in taxes. All of a sudden you can say, wait a minute, I've got this property that I bought in 2018. I never did a cost seg study. You can do a cost seg study on that property here in 2025, take all that missed depreciation from 2018 to 2025, drop it on your current tax return.
Uh-huh.
And in your case, like you said, we get to use the bonus depreciation rules that were applicable the year the building went into service, because bonus was at 100% in 2018. Here in 2025, it's only 40%. So we get to take the 100% bonus, bring all that missed depreciation forward, take it on our current tax return without having to amend. Now, it does require an extra tax form. It's called a 3115, or it's a change in accounting method. It's interesting, Keith, on that 3115, we fill that out as part of our service. It's an ugly 9-page tax form that nobody wants to have to fill out if they don't have to, but you're actually checking a box on there that says we're going from an impermissible method of depreciation to a permissible method. Again, we're telling the IRS, hey, I screwed up. I was depreciating my carpet over 39 years. I should have depreciated my carpet over 5 years. And because I made that mistake, here's the difference and here's what you guys owe me in deductions. And all that gets to be done without ever having to amend any prior year's return, which is great. So look-back studies are a great way. It's a great tax planning tool. Maybe you don't need the deductions. Maybe I buy a property this year. I don't need any additional deductions. I get to keep cost seg in my pocket for a year down the road when all of a sudden I do need the deductions. Maybe I'm making higher income or I've sold another property and have a large capital gain event. I get to kind of use the cost segregation study as needed or when I need it most to maximize the tax savings. And that's, again, one of the few deductions that I know in real estate that you can kind of pick and choose what year you utilize those deductions.
And what if you don't? And I know obviously neither one of us are CPAs, but what if you don't use? Let's say you did take deductions on a property and you don't use it all. Are you able to carry some of that over to the next year?
Yeah, it actually carries forward indefinitely. So that's a great question. So we do a cost seg study. We create a $500,000 deduction. You've got $300,000 of income. We wipe out that income. You pay no tax on it. The remaining $200,000 carries forward into next year, and we'll wipe out the first $200,000 of income next year. Yeah. And so, and if you don't have $200,000 next year, it just keeps carrying forward until it's all used up. So you never lose your deductions. It just carries forward indefinitely.
Okay. Yeah, it's a pretty amazing tool. One of the things I've found with it as well, I mean, I've used it in my own, you mentioned having a short-term rental. I don't know if you did one on yours, but yeah. They kind of bought mine at the end of the year with the intent of utilizing it. I had sold a mobile home park in the same year and did pretty well on it would have had capital gains taxes. Yeah. And it really wiped out my capital gains taxes, which was amazing. So, I mean, if you're buying property on a regular basis and selling it on a regular basis, this is definitely a tool that any investors can use, and oftentimes it can really minimize their tax liabilities.
Yeah, no, definitely. That's a similar situation I was in. It was at the end of 2022. I had a tax liability and I needed some deductions. And so towards the end of 2022, we decided specifically to buy a short-term rental. And there's a reason for that. And we should probably just touch on it quickly.
Yeah,
but
for sure. Yeah.
I had a long-term rental already, but I'm a W-2 employee. My wife is a W-2 employee. She works at the school district. And so if I would have done a cost seg study to create deductions on my long-term rental, I would not have been able to use those to offset me and my wife's W-2 income because that is a passive activity. I own this long-term rental on the side. My active income comes through my W-2. So when you do cost segregation on your real estate, typically those are considered passive deductions and they can only be used to offset passive income. So I could have done a cost seg study and it would have helped me to write off my rental income, but my rental income wasn't where my tax problem was. My tax problem was from my W-2.
Right.
And so we specifically went out and bought a short-term rental. And as long as the short-term rental has a few qualifications, one is the average stay has to be less than 7 days. So most of your Airbnb, VRBO type properties, the average stay is less than 7 days. You take the number of times it was rented by the number of unique renters, and as long as that's less than 7, it gets treated differently than a rental property. It gets treated more like a hotel. And so the IRS looks at it differently. So I met the 7-day period. I met that limitation. But then the other thing is you have to materially participate in the management of that property. So there's 7 tests that the IRS puts out, and you only have to meet one of the tests. And the test that me and my wife were able to meet was we spent 100 hours on the property and more time than anybody else. And I was strategic about that. I bought it at the end of the year because I didn't want my cleaner to be there 100 hours. I didn't want my maintenance guy to be there 100 hours because I knew that I had to spend more time than anybody else to meet that material participation test. Because I met that test, the IRS looks at it like I own and operate a hotel or a bed and breakfast or some type of hotel type property versus a long-term residential rental property. And so because I own and manage this business, it becomes active deductions. And now I can use all that depreciation. In this case, on the one we bought, once I did the cost seg study, it was about $145,000 of depreciation. I was able to offset $145,000 worth of income that me and my spouse would have had to pay taxes on. So if we're in a 30% tax bracket, $145,000, $150,000, that's about a $45,000, $50,000 tax savings.
Yeah.
So I actually got about 70% of my down payment back on that property in the terms of tax savings by utilizing cost segregation on that. So now that was at a time when there was 100% bonus, which I think we'll touch on, but still, it's a great way. I was going to give that money to the government or I was going to buy a property. So I bought a property. It's a revenue generating property. It's going to appreciate over time. And that's how I'm able to hopefully build some wealth down the road so that I don't have to just pay my money to the IRS and cross my fingers and hope they do something productive with it. So that's the idea.
And you were able to actually deduct that off of your W-2 in your situation. See, with me, I didn't. I wish I would have known that. For years and years, because it was W-2 up until November. Now I'm a full-time investor, but could have used it strategically, like you said. Where you buy it towards the end of the year. Certainly that would have been huge. Like you said, just to offset down payment investment, that kind of thing, and allows you to be able to continue to invest. I remember when I first started investing and just kind of scraping my money together for my first rental property and then thinking, okay, here's a strategy, but man, it's going to take me a while to save up that down payment each time. But if you had a strategy like this that you were using along the way, it would have made it so much easier to build wealth so much quicker. Yeah,
no, definitely speeds it up a little bit if you can get some of those down payments back. And that's again why the government utilizes bonus depreciation, is to help stimulate the economy. And that's the whole reason behind it. And so they're incentivizing us to go out and buy stuff just because it helps the economy. It helps transactions. And so, it's a great way to kind of speed up that process.
Yeah, for sure. And it makes sense, even if, I would be curious to know what your thoughts are. Obviously, neither one of us have a crystal ball, but I sure hope with this new administration that we go back to 100% bonus depreciation. I really haven't heard all that much. I've heard speculation on real estate podcasts and stuff similar to this, but not, nobody for sure knows. I haven't really heard a whole lot of promotion of, hey, we're going to go back to this. But maybe you have, since you're in the industry, you probably, your ears are probably tuned into it a little bit more than mine.
Yeah, there was, it was actually back last year about this time where Congress put forth a bill to extend the 100% bonus. And they were going to extend it through 2025. And when they did that, it made it all the way through the House. Almost unanimously, people vote for it, had bipartisan support. It got to the Senate, and there was just a few senators that said, wait a minute, we're in the midst of a presidential election this year. If we pass this now, this could look good for Biden. So let's hold off on it. And so they held off on it till after the presidential election. I'm hoping that they can get their act together here in the next month or two and get this passed before we start filing our 2024 taxes, because if they do, they'll probably retro it back to 2024.
That'd be
Worst
great.
case scenario, they don't get it done before we file our 2024 taxes. My guess is that Congress is going to get together. Now, whether they tell you they want it or not, 90% of the people in Washington own real estate. They want bonus depreciation back, regardless of what political party they're on. I think that we're going to see a comprehensive tax bill before the end of the year, has bipartisan support. I think it will include 100% bonus depreciation. They'll probably reinstate it for 2025. Right now, for 2025, bonus is at 40%. So instead of 40%, it could go up to 100%. But they've got to get their act together and get something pushed through. And I do think it'll happen. Like I said, most people in Washington own real estate. They understand the advantage of bonus depreciation. So I think there's some incentive there to get it passed.
Yeah, I think so, and I think it will cause more transactions. I mean, like you said, there's a huge benefit to doing it. There's people that you can utilize it in a number of different ways, and I think it just to me, I just see from an investor standpoint the flexibility of not necessarily having to always 1031 into something. I mean, the 1031 is a great tool, but the problem with it that I've personally experienced is, I went to do a 1031, had my money sitting, with a custodian of the 1031, and then the property didn't work out,
Yeah.
and then it was kind of stuck there until I filed my taxes, and was able to, obviously then had access to it again, but it was kind of held up there for a little while. I didn't just automatically, I didn't tell them, hey, I can't do the 1031, and they give it to me right away. It was
Right.
like, hey, you got to file your taxes, provide it to us, and then we'll release it. So I found it to be a little bit of a hassle. And then there's kind of, you're under the pressure to buy a property and name a property and execute on one. And sometimes I know investors that go through with a purchase when it doesn't necessarily, fit exactly what they were hoping for, but they do it
Right.
specifically to avoid the tax liability.
Yeah. No, that's a great point. There was I'm trying to remember who it was. I heard somebody call, when we had 100% bonus, that was a great strategy to not have to do a 1031 exchange. You would sell a property, you have a large capital gain,
Mhm.
you would take that capital gain or the proceeds from that sell, go buy a new property in that same calendar year, and then do a cost segregation study. And because there was a 100% bonus, that just puts our cost segregation study on steroids, and you would get a huge deduction in that year, which oftentimes would offset most, if not all, of that capital gain. And somebody referred to it, I can't remember who it was, as a poor man's 1031 exchange. But essentially you're getting the same benefit, but now you have access to the money. It doesn't get tied up in a custodian. You could pull some of the money out if you needed to. Maybe you didn't want to reinvest all of it. You only wanted to reinvest some of it. It was a lot more flexible. But, bonus depreciation, as we've talked about, has started to phase out. It was at 100% for any assets that went into service 9/27 of 17 through 12/31 of 2022. All those properties were eligible for 100%. In 2023, it went to 80%. Last year, it was at 60%. And then if we go forward with it at 40% this year, or like I said, hopefully keep our fingers crossed, they get a bill passed where we can increase it back to 100%. But very powerful stuff. It just makes it a lot more flexible. It gives us more options when we're looking to dispose of a property.
For sure, for sure. And I think, obviously, regardless of whether they go back to 100% or not, just the cost segregation study alone, the tax benefits, as you pointed out, make it well worth doing, being able to actually take some of that. Because there are some downsides as well, right? So if you do take, for instance, I'll use my short-term rental as an example. Our first year, we didn't do quite the numbers I was hoping for. And so then I'm like, okay, I didn't really buy it as a second vacation home, nice
Right.
to have, but, I really was buying it for the purposes of cash flow, that kind of thing. And so I had thought about it, selling it, and then, then you're stuck with the fact that you're going to get some recapture on that. And there's some, for every benefit that there is sometimes a downside as well that you just have to incorporate and keep in mind. If
Yeah.
you were an investor, you're active investor, the way I look at it, you're buying enough that you have the ability to kind of offset these problems as they kind of come up.
Yeah. No, I would definitely agree. As long as you keep investing, where sometimes people get in troubles where they take all the depreciation and they no longer want to go into real estate. And now we can keep kicking the can down the road. The idea is for a lot of investors is 1031 exchange, 1031 exchange, 1031 exchange. Then you die, your estate gets a step up in basis on that property, and then nobody pays tax on all that gain that's been appreciating over time, or all that gain.
Yeah.
But yeah, if you 1031 to 1031 exchange, 1031 exchange, and then you decide you no longer want to get in real estate and you want access to that money, then there is going to be some recapture that you've got to make sure you're planning for to be able to pay that recapture tax.
For sure. which again is probably a good reason to kind of, consult with your tax planner, not just your CPA, but just having somebody that you can really sit down with, strategize, and, make sure that you're utilizing these things. Because like I said, I have several other properties before I kind of found out from a friend about this cost segregation. Man, I wish I would have known about it, years and years before that. Could have utilized it so much more.
Yeah, definitely.
So, where all do you and your team operate? I'd like to maybe go back to talk a little bit about some of those kind of exceptions as well. But first, where all do you do a cost segregation study? And then tell us a little bit about the process of what that looks like.
Yeah. So we actually operate in all 50 states. So we've done business in all 50 states. We have offices in about 10 states, 10 locations across the country. Kind of the process is we always want to make sure we run some preliminary numbers before we ever engage anybody to do cost segregation. Because I don't want you to pay for a study if you can't utilize the deductions or it's not going to create a tax savings. So the first thing we do is gather just a few pieces of information, purchase price, building address, etc. 4 or 5 different pieces of information. We'll run some preliminary numbers and say, okay, if you were to do cost segregation, we're going to accelerate your depreciation by, 200,000. If you're in a 30% tax bracket, that equates to a $60,000 tax savings. And here's your fee for the study. It might cost you, $3,000 or $4,000 for the study. Once you've gone through that process, we usually turn those benefit analyses around in a day or two. Once you've gone through that, you've shared it with your tax preparer, they're on board, then you would engage us to do the actual work. Once we do the work, it's usually about 30 days from the time you sign your engagement letter till the time you get the final report. So a big portion of that timeline is the IRS does require a site visit to be done on each of these properties. So that's scheduling that and getting that completed is usually what takes the most time, to be honest with you. One of the nice things that came out of COVID is we can now do some of these site visits virtually. So we used to actually send our engineers, all of our engineers are here in Salt Lake. We used to send them all over the country to do site visits on different properties. And as you can imagine, it's very time extensive for them to be flying. And then maybe they're flying to Maine for one property and then they got to fly back. And so one of the nice things that came out of COVID is we can do a lot of these site visits virtually now. So we have a video conferencing app similar to like a Zoom call where a property manager or a building owner's got their smartphone. We've got our engineers on the other line. We're walking through the property together. We're saying, okay, show us the electrical panels, show us the flooring in the kitchen, take us outside. There's certain things we need to see to conduct our study. Once that's been completed, it's usually about 10 to 14 days that you'll get the actual report. The report itself is about a 40 to 50 page report. Honestly, Keith, your tax preparer is going to skip the first 49 pages. They're going to go to the last page, which is a revised depreciation schedule. It's going to have each of the asset classes and how much there is in each asset class. They're going to upload that into their tax software, and that's how you're going to realize your deduction. And that's kind of the process. There's not much more than that. Other than if you ever were to find yourself in an audit, I wouldn't let an audit scare anybody on a cost seg study. We've done close to 25,000 studies. We've only been involved in just over 30 audits over the course of those years. I will say there has been a bit of an uptick in the last 8 months in the number of audits we're seeing. The IRS was infused with a bunch of money a couple years ago. They went out and hired a bunch of new agents, and I think that they have started looking at these cost seg studies. I think they're doing more audits in general. And then when they're auditing you and they say, oh, I see you've done a cost seg study, they're going to ask to see the actual report. And so it's important that you get a quality report and are working with somebody who's going to provide audit support. But we have a team of people who will provide audit support should we need it. And it's very easy, to be honest with you. The last couple I've been involved with, to be honest with you, these agents they seem very new. Like we're trying to explain to them what bonus depreciation is and why we can utilize it and showing them the code where it says we can utilize it. And so, they ask you a list of 10 kind of standard questions and we answer those questions. We show where those answers are in our report and they kind of go away at that point. So, but that's kind of the process that you'll look at if you were to do a cost seg study.
Okay. No, that's helpful. What about, is there, let's say you bought a property and then you have since done improvements on the property. You didn't do a cost segregation study right away. How much of is there any thought that needs to be put? Like, let's say I buy a property that I'm intending on putting a lot. Car wash would be a good example. I have a friend that just last year bought a car wash. He spent a lot of time and money on upgrading all the equipment. Uh, do you guys look at the equipment as, okay, this stuff's brand new, so it's gonna, I don't know what all the considerations are. That's one example, but there may be other improvements that you're doing to the property. If you're putting in a new driveway, if you're doing this or doing that, are there things that, if they're new or have been done recently, they're gonna warrant a higher depreciation amount, or does it, in other words, is there ever a consideration where it's like, hey, you're planning on doing this cost seg, but to get the most out of it, let's wait until after these repairs or these improvements have been done, and then we'll do it?
That's a
Do you
good
understand
question.
my question? Yeah.
Yeah, no, I understand where you're going. So that's an interesting question because the answer is it depends. So I'll give you two examples. Let's say I buy an empty warehouse that's vacant. I buy it, and then I'm going to spend $500,000 fixing it up. I would wait to do the cost seg study till after I've spent that $500,000. And the reason for that is because it was never placed into service when I bought it. I bought a vacant building. I spent $1 million. Let's say I spent $1 million on the building and $500,000 fixing it up. I would do a cost seg study in that example after the renovations were complete, and my basis amount would be $1.5 million. The $1 million I paid for the building, the $500,000 I paid for all the stuff I put in the building, I would do the cost seg study. Now, there is opportunity if the building goes into service prior to your renovation. So I'll give you another example. Let's say I buy an existing retail shop and I've got a tenant in there, and I'm going to kick them out in 6 months when their lease is up, and then I'm going to spend my $500,000 fixing it up. In that scenario, I bought $1 million building. I want to do the cost seg study before I do my renovations. The reason for that is all the carpet that's in that building, all the window coverings, I'm going to take as much depreciation out of that stuff as I can. Then I'm going to dispose of that stuff. When I dispose of that stuff, I no longer have to pay recapture on that old carpet. I'm then going to put the new carpet in, and I'm going to take depreciation on my new carpet. So in that second example, I actually get to depreciate 2 sets of carpet, and I'm going to get a bigger deduction. The first example, even though when I bought that warehouse, there was old carpet in there, that old carpet was never used for a business purpose. It was a vacant building. I had to put money into it to make it usable. And so that old carpet you don't get to take depreciation on it. So anytime you buy a bill, I'll give you a car wash example. Actually, here's a great car wash example. This was a friend of mine at the end of the year, needed some deductions, bought a car wash. The car wash wasn't making any money, but he wanted the deduction. So he bought the car wash, took all the bonus depreciation. The following year, he knocked the car wash down. All that stuff just goes to land value. And then he built fourplexes where the car wash was. So he could have bought the building, bought the car wash, knocked it down, put up the fourplexes, and then done the cost seg study after the fourplexes were up. But we wouldn't have been able to take depreciation on any of the car wash stuff because that stuff's all gone. And so we would have only got the depreciation on the fourplex stuff. But because the car wash was in service, that's the key, is it's got to be in service. So if it's in service, then you want to do the study before you do the renovations because you're going to get all that depreciation from all that old stuff, the old carpet, the old countertops. We're going to maximize those deductions. Then we're going to get rid of all that old carpet. After we've taken the deductions, we're going to put new carpet, new countertops, and now we get to take those deductions as well. And so anytime you can put a building into service before you do renovations, you want to do your cost seg study before the renovations are complete. So we've seen some unique situations where I buy a vacant building. It's vacant. Let's say it's a single family home. I buy a vacant single family home. It's all beat up. If I can find tenants to move in there, even if it's only a 3-month lease or a 6-month lease, that may be worth it because now I'm going to take all that depreciation out of the old stuff because it's in service now.
Mhm.
And then when I renovate it, I'm going to get the depreciation on the new stuff. So sometimes it makes sense just to throw a renter in there for a short period of time so that we can call it in service. Now, depends on how risk adverse you are with the IRS and audits. You got to make sure that your intent is to rent it. If you only put somebody in there for a day and say, hey, rent it for a day so I can call it in service, the IRS is going to be like, yeah, you only did that to maximize the deductions. But I think it's very reasonable to buy a vacant property, put somebody in there for 3 months, say, hey, I wasn't getting the rent that I wanted because the place was beat up. So I kicked them out. I renovated the place and now I can rent it for more money. In that situation, you get basically depreciation on 2 sets of carpet, 2 sets of cabinets, all that stuff. So that was a long answer to your question, Keith, but the answer is it depends
Yeah,
on
no,
whether the building is in service or not before the renovations.
and you mentioned, so let's say you did a scenario similar to that where you did have it in service, then you did a major, so you took the deductions there, you did your cost segregation. Now, are you going back and doing another cost segregation study once you've, like the example on the fourplex that you put over where the car wash used to be? You did one initially, then you're doing one again. Are you doing another cost segregation study, or are you just taking depreciation now on the fourplex?
Good question. So in that case, we do a cost seg study on the car wash.
Mhm.
And in that case, we did do a second cost seg study on the fourplex.
Okay.
The reason for that is sometimes you have to and sometimes you don't. And I'll give you the scenarios. In that case, because the fourplex was an extensive project, they put in all new, it was built from the ground up. There was electrical, there was plumbing, there was permits being pulled. There was all kinds of costs that went into building those fourplexes. And so it was advantageous for the buyer or the builder to do a cost segregation study because we were going to be able to create a lot of deductions. Now, let's use a different example where I buy a single family home for $300,000 and I'm going to spend $10,000 on new paint and new carpet. In that case, we should do the cost seg study on the original purchase, but on the carpet and paint, you don't need to pay us to do a cost seg study because you have an invoice for the paint and you have an invoice for the carpet. So in that situation, I would recommend take those invoices to your CPA. The carpet, as we mentioned, is a 5-year asset. They have an invoice for it, so they know what you paid for the carpet. So they could just put carpet on the depreciation schedule. They'll put carpet, $5,287 based off the invoice, and they'll depreciate it over 5 years. They don't need us to tell them what the carpet is valued at.
Okay.
The reason that I would say do the cost seg study on the fourplex is there's going to be, you still have invoices for everything because it's brand new construction. So you've got an invoice for everything. But where cost segregation will benefit you on a project that size and scope is things like you're going to get an invoice from the electrician that says electrical work, $80,000. If you don't do a cost seg study, that electrical work stays in that long-term bucket.
Huh.
If you do a cost seg study, we take that electrical work, that $80,000, and we break it up into different parts. Some of that electrical work stays in the long-term bucket, but some of the electrical work for the range hood, for the garbage disposal, for the ceiling fans, for all the appliances, that all gets to be depreciated over 5 years. So we get to take that one invoice that says $80,000, and instead of putting it and splitting it up over 39 years, we get to take a big chunk of that out and depreciate it over 5. Another example of that would be finished carpentry. We see that quite often. You get an invoice from a contractor that says finished carpentry, $20,000. Well, finished carpentry could be the door frame behind me, the frame around the door. That's a long life asset. But finished carpentry could also be crown molding, which this office doesn't have. But if there was crown molding here, that's a short life asset. And so having the knowledge to be able to pick and pull apart those invoices on a big project like that does create additional tax savings. But if you're doing a simple renovation where you're throwing in some paint, carpet, and maybe a new roof, that's only 3 invoices. There's not really anything for us to do. Just take those invoices to your tax preparer. They'll know how to handle them appropriately, and there's not much for us to segregate out. So again,
Okay.
I know I keep giving you the answer, Keith. It depends, but
It depends.
It depends. That's why you got to, and we walk people through this, Keith. So I don't want your listeners to think they have to know all this stuff. They would call us and say, hey, here's what happened. I bought this building. It was in service or it wasn't in service. I put X amount of money into it. Here are the type of renovations I made. And then we'll come back to them and we'll say, hey, that's going to require 2 studies. It's going to require 1 study, or maybe it doesn't require any studies because it just doesn't. And so we always want to, that's why we run that free analysis so that they have a good idea of what to expect and what the cost would be. And again, we don't want to engage anybody and say, hey, pay us $3,000 if they're only going to save $2,000. But if you're going to save $60,000, then yeah, pay us $3,000. We'll get you the $60,000 in savings and everybody's happy. So it's important to get that initial analysis run so that everybody knows what the tax savings looks like.
Yeah, makes sense. And I know we're going deep on it. I just had one more question on the say the example that you gave on that the paint, the carpet.
Yeah.
Are you able to take that to the invoices to your CPA at that point because there was originally a cost segregation study and they're referencing the cost segregation study, or does the CPA or should the CPA know that, hey, this is carpet, this is paint, these invoices that were turned in that year, now we should be depreciating it differently? I mean, it just seems like
That's
sometimes.
a great question.
Yeah.
No, that's a great question. So whether you have a cost seg study or not, if you spend $5,000 on carpet, you should add that to your depreciation schedule and it should be depreciated over 5 years, no matter what.
Okay.
Now, does every CPA out there, every tax preparer know that? No, they don't. There's an IRS book that's probably 2,500 pages, and it tells you how to depreciate every single asset you could ever think of. You would have to go to that book and figure out, okay, what type of flooring is it? Is it laminate? Is it ceramic tile? Like ceramic tile has a life of 39 years. Carpet has a life of 5 years. So you have to know what gets depreciated over what. So some CPAs will be able to do that. Others won't. But yes, now what should happen, and we see this done incorrectly all the time, is let's say you don't do cost seg study. So on your depreciation schedule, it'll say building $1 million. And then 2 years later, you put a new roof on and you'll say you spend $50,000 on the roof. That roof will be line itemed underneath it. So it'll say building $1 million, roof $50,000. Well, what's happening now is now you're depreciating 2 roofs at the same time because you've got the new roof you just added, but then you have the old roof, which is stuck in this line item that says building, because that building consists of all the different pieces of that building.
Yeah.
So now you're depreciating 2 roofs at the same time. What should happen is it's called a partial asset disposition, but if you had done a cost seg study on the first building or on the original building, you would have had a line item that said roof, $100,000. When you put the new roof on, you get to take the old roof, the remaining book value of the old roof off of the schedule and write it off as an expense. Because you're saying, I'm retiring this piece of equipment. I'm retiring my old roof. I'm putting a new roof on, and you start depreciating the new roof starting the day that the roof goes on. But what happens is people depreciate 2 roofs at the same time, which means they're taking too much depreciation, and it ends up making them pay more depreciation recapture at the end because it's the IRS saying you took too much depreciation.
Yeah.
What should happen is you should pull the old roof off, write it off as an expense, which is great. You get all that expense and you never pay recapture on it, and then start depreciating the new roof.
Yeah. It's crazy. There's a lot of nuances, and you're right. I mean, not every CPA knows this, and a lot of them are just taking the kind of the easy route when it comes to depreciation. Maybe not. I'm not, disparaging what they do by all means. I don't love filing taxes, and they're handling that right. But
you see that all the time, Keith, because it's not that your CPA or your tax preparer is incompetent or they're negligent. It's that the tax code is thousands and thousands of pages, and they're kind of like the general practitioner. They have to know a little bit about a whole lot of different subjects, and they just don't have. Nobody has the bandwidth. It's not, again, nothing personal to that specific CPA. There's no CPA that has the bandwidth to go deep down and do a deep dive on all these different subjects, and so that's why. And I think we partner with close to 5,000 CPAs now across the country. to do just what we do. We don't do tax returns at our firm. We just do this one service because, I don't know anything about earned business income or child tax credits because I don't do tax returns, but I know a lot about depreciation, but that's
Right.
only because I stay within like these 5 pages of the tax code.
Right.
So
Makes sense.
again, your CPAs aren't incompetent. They just don't have the bandwidth. So no fault of their own, but that's
For
why we
sure.
partner with them.
Yeah, makes sense. Well, this has been great, Erik. If we could, maybe let's shift to how people can find out more about you, how they can contact you.
Yeah.
And if there's something that we didn't mention that you were hoping I would get to, let's take the time to go through that. If there's something I missed.
Yeah, no. To get a hold of us, you can go to our website. It's just www.costsegauthority.com. That's COSTSEG authority.com. My contact information is up there. Please use this as a resource, you guys. You can actually get a free benefit analysis on that website. So if you have a property you think might be a good candidate, you just click the button, input a little bit of information, and then within 24 to 48 hours, we'll get back to you and give you a benefit analysis. And then, again, use this as a resource, guys. We don't bill by the hour or anything like that. If you've got a question, I think the weirdest question I've ever been asked is how to depreciate mule deer at a breeding facility in Wisconsin. And, I didn't know the answer to that, but we were able to find the answer. And so please use this as a resource, guys. We'll be able to at least connect you with the right people if we don't have the answer for you in-house.
Perfect. Well, this has been great, Erik. I've got 2 other questions for you that I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
Great question. So I give this advice quite often. I think I've had to learn this, and I've seen probably hundreds of people by now learn this the hard way. And that is, there is a huge difference between a tax preparer and a tax strategist. And as you build your portfolio, it's important that you're working with a tax strategist, not just a tax preparer. So a tax preparer takes your W-2s, your K-1s, they input it into their software, and it spits out a number and says, you owe this much in tax. That is a tax preparer. A tax strategist will take those K-1s, they'll look at your W-2s, and they'll start to offer advice on how to reduce your tax liability. So if you're just meeting with them once a year, that could be a problem because it's probably too late by that time. And so you need to, as you build your portfolio, get somebody on your team who understands tax, who understands real estate, and they're going to be a little bit of money. You're going to have to pay more. It costs more to have a tax strategist than it does a tax preparer. But the amount of money that a tax strategist should be able to save you if they're good at their craft is going to be 10 to 100-fold what they're charging you. So
For sure.
just make sure you're working with, again, as you're building your portfolio, you're becoming more and more of a complex taxpayer. Find somebody who really understands real estate, and that way you'll be able to save significantly more in taxes.
Yeah, makes total sense, and I think it's great advice. How about a book recommendation? Doesn't have to be real estate related. Certainly can be. Just something you've read that's been impactful.
I will keep it real estate related because it kind of fits into what we're talking about. But there's a book by Tom Wheelwright called Tax-Free Wealth. Tom Wheelwright, he is Robert Kiyosaki's CPA. Probably heard of Robert Kiyosaki, Rich Dad, Poor Dad. But Tom Wheelwright has a book that talks a lot about what we talked about. It's called Tax-Free Wealth. It goes into a lot more depth than just depreciation. But it's a great book as you're starting to, again, build your portfolio. Oftentimes, Keith, we all look at like, how do I get more income? I got to buy more properties. Well, I'll use a sports analogy. If you score 130 points in a basketball game, but you give up, or the other team scores 131, then you've lost the game. So it doesn't matter how much money we bring in if we're paying all that money out in taxes. And so it's important to make sure again, it's bad sports analogies, but you got to play defense, not just offense. And so Tom Wheelwright talks a lot about that in his book on how to not only get money in, but it's not how much you make, it's how much you keep. And so we just got to make sure we're not overpaying in taxes.
For sure. Because as you said, and kind of as you laid out at the very beginning of this, it's really, if you're not taking advantage of the tax code, not utilizing, I should say, the tax code the way it should be, you're really doing it wrong. And right. So, some of these tools and various things, whether it be the tax strategist, whether it be the cost segregation study. All these things are designed to help you, actually file your taxes correctly. So it's not cheating. It's just knowing, what to do, and that in turn puts more money in your pocket. So this has been great. Appreciate it, Erik. Thank you so much, and I think we'll call it a show.
All right, sounds good. Thanks for the opportunity, Keith. Have a good day.
Yep, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.